Mid-market clearly has, especially in Europe, had the problem of banks essentially retrenching from the lending space. And you've seen that across the board, and you're still seeing it, that banks are lending less. And so as a result, I think it's opened up a lot of opportunities for direct lenders, private debt funds across Europe in particular. And then you've seen that in the US as well. And the US is clearly a much more established market because the bank retrenchment happened at a much earlier and faster pace. And so it is a unique space in that context that I think, number one, it's opened up a lot of opportunities for direct lending funds, particularly over their last sort of 6 to 7 years. And I think that's still continuing. And especially if you look at the share of mid-market lending in Europe versus the US from private debt funds, i.e. what share do private debt funds have in terms of the overall lending landscape, it's still a very tiny portion in Europe. And so I think there's still a lot of room to grow for all the private debt funds out there. And you're seeing that in the market in the sense that a lot of the funds that started with senior-oriented direct lending in Europe, that they're now onto their second, third, fourth vehicle, and are clearly doing this and deploying capital reasonably successfully. And so I think there's a lot to go for still in that mid-market, both in the lower middle market as well as in the middle to upper middle market. I think it's not that easy, clearly, to diversify or to set yourself apart if you're focused on, say, just pure mid-market lending. And the vast majority of the opportunity set, especially in Europe, again, to focus on Europe, has primarily been in the sponsored lending space. Sponsors or private equity firms are typically more sophisticated users of capital, if for lack of a better word, I'd say. And so as a result, I think a lot of these private equity firms have, clearly were the first users, or private equity owned businesses were the first users of capital from private debt funds or direct lending funds. But that has changed clearly over time as the market matures. And again, I think to focus on Europe particularly, because I think the US market is more established. In Europe, you've seen an emergence of funds that focus on sponsorless lending, or companies with a private sponsor, not really a pure play private equity firm. And I think companies generally, businesses in general that are not private equity owned, are seeing how direct lending funds operate, have worked with direct lending funds now, and so the acceptance of direct lending funds has increased materially over time. The UK, I think, was a front runner, but I think you're seeing other European markets as well. And again, going to the US, a lot of businesses today are funded by direct lending funds, and so there is a general acceptance in that sense. And so I think one aspect in terms of the European market is that a lot of funds can differentiate themselves by focusing on sponsorless lending, for instance. But then I think as the market matures, you're also seeing an emergence of other niche strategies. And so to set yourself apart, I think you are seeing certain managers that are establishing country-focused funds, again, to cater to specific market opportunities in specific markets, number one. I think you're seeing also a number of managers that are focusing on specific areas of the lending landscape. That could be invoice discounting, that could be asset-based lending, that could be healthcare royalties. Again, a lot of these areas or specific niche strategies already exist in the US, and they're now coming to Europe. And then finally, I think that one area of diversification, or one area of, I would almost call it bifurcation, is what you're seeing now in the market is a clear bifurcation between some of the very large lenders that are focusing on large situations, more complex situations, versus lenders that are in more niche strategies and are focused on keeping small fund sizes and focusing, say, on the lower middle market or on certain areas of expertise that they may have established in a certain sector or in a certain region. And so I think ultimately you'll see a bit of a bifurcation in the direct lending market or in the general private debt space, where there will be a handful or maybe two handfuls of very large managers, again with the focus on Europe, and a number of more niche, smaller managers, and less sort of that middle ground of managers that are trying to focus on everything and nothing, if you will. Well, I think the concern and also the opportunity in this sense is that everyone talks about being at a late stage in the cycle, and that a lot of the private debt funds and direct lending funds out there haven't actually gone through a crisis, haven't gone through a full cycle. And so when you're looking at returns and when you're looking at sort of their track record, everyone typically has a pretty positive track record, and so you can't necessarily see how these managers will perform during, if the cycle turns and when there is a crisis. And so that next crisis will come, the cycle will turn, and when that turns, I think you will see a separation of the wheat from the chaff, as if you will, I guess. A lot of managers will perform very well because they have established teams, they're set up, they have an institutional setup, perhaps they may have a workout team, or they've gone through previous experiences like this. And others may have problems. And I think you will see that a lot of the funds that don't necessarily have the most disciplined underwriting standards, lending standards, will suffer. And clearly, I think in that crisis, you will see certain managers disappear, potentially. There will be more consolidation. And I think in the US, again, there has already been some consolidation. So you've already seen managers, even in a positive economic environment, having difficulties in terms of raising their next fund or being able to deploy capital because they've had difficulties in their portfolio. And so I think when the crisis comes, you'll see much more of that happening. And I think that is clearly a concern as an LP or from an LP standpoint, but it clearly is also an opportunity for the overall market, because I think that is the necessary step for the market to mature even more, especially again in Europe. And I think once that happens, you will get a much better sense of who is good and who is not so good in the market.